Hello everyone and welcome to my channel. And each video I would like to answer a very basic question about stock investing. And today's question is a very simple one that you might also have asked yourself already. It's like, if I would invest money in a well-established company, a large company, like the ones listed in the S&P 500, would I still be able to make a great return? Okay, so the very first question that we have to ask ourselves, what is a great return? Now, this can be quite different for everybody. So some people might say, well, 10% per year for me is a great return. Other people might say, well, if I'm able to beat the market, if I do better than the S&P 500 index, I am doing very well. But you know what? Let us be very ambitious here and let's use the definition that Peter Lynch gave to a very successful company, and that's called a 10-bagger. So a 10-bagger is a stock which price will be multiplied by 10 over 10 years. So if you invest $100,000 in a stock, in this case listed on the S&P 500, you would be able to have $1 million 10 years later. What does it mean in terms of absolute growth? Well, a stock that is, that's getting 10 times its initial investment is growing for 900%. 900%, and that equates, if you would turn it into compounded annual growth, it's about 26% compounded annual growth. So we're going to look now in the S&P 500 in the recent past and see if we could find any of those stocks out there, stocks that made a return of 900%. Now let's first look at the S&P 500 index in general. And what you see here, and this is 10 years, so September 2011 until September 2021. And we see that the index, the S&P 500 index, has grown quite well over that last period of 10 years. So it was around September 2011, it was around 1,000 points, and now it's over 4,300 points. So it went up for a total of about 280%, which is almost quadrupling the index there. So very, very strong performance of the S&P 500. So this already gives me good hopes that we will find some very well performing companies out there. Okay, what you have here is the full list of the 505 constituents of the S&P 500. And you see for each company, each stock, how it performed compared to year to date, 1 year ago, 3 years ago, 5 years ago, and 10 years ago. So, well, the question might be, are there any 10 baggers out there? So are there any companies that have grown for more than 900% over the last 10 years? So we can quickly filter them out. And that's simple. We do here a little filter, greater than or equal to 9, because it's hundreds of percent. And we get here a quite extensive list of companies here. Well, however, we have to be careful. Now, if we want to be fair in our calculations, we have to be careful. These are all 10 baggers, but there are two things we have to take into account here. First of all, not all of these companies here were listed in the S&P 500 10 years ago. And let me take a very simple example that you all know. For instance, Tesla. Tesla is probably showing up in the list here. Yeah, here's Tesla, because Tesla is now a company of the S&P 500. However, it was only listed on the S&P 500 late last year. So the list date for Tesla, and the date here is December 21st, 2020. So it's not really fair to say that Tesla is a 10-bagger in the S&P 500, because if you would have bought Tesla 10 years ago, yes, you made more than 10 times your return. You made actually 160 times your return already. But if you have bought Tesla 10 years ago, it was not part of the S&P 500. So you really have to start looking from the date it was listed into the S&P 500 until now to see if you have 10-bagger or not. So Tesla only went up 10% since late last year, which is definitely not a 10-bagger in the S&P 500. So then there's a second thing we also have to take into account, is that if you just take this list here, I'll remove the filter, yeah, there are also some companies here that did not even exist or were not publicly listed 10 years ago. Like take IQVIA, which was renamed. So there are other companies that were not listed 10 years ago. Maybe they changed names, maybe they had a merger or whatever. But yeah, those companies we also have to take into account. It could be that a company was listed after 2011, yeah, and still made a 10-bagger status. So that's what we'll have to find out. So a better way to probably look at this data, instead of looking at a trailing return chart, is to look at a yearly return chart. So a yearly return chart, as you can see here, is also showing the 500 stocks of the S&P 500. However, it will show the yearly performance. So it's showing calendar years. So if you would take here Apple, yeah, what I've done here is look at the performance of Apple in 2011, meaning that I looked from January 1st, 2011 until January 1st, 2012. Yeah, and during that calendar year, Apple went up 25.56%. The year after, in 2012, it went up 31%, and so on, and so on, and so on. Now, what you can see here, and that's an interesting chart here, is that the stocks did not really all go up very constantly. There is really a patchwork of colors here, really saying that, hey, some companies go up one year, then they go down one year, go up one year, and that's exactly what is to be expected when you invest on the long term. However, if you start to look at these things in a cumulative way, and that's what I did here on the right, if you would just bear with me, here are the companies, and here I laid out the returns, the growth of the stocks, but then in cumulative way. So start 2011 and then 2012, 2013, and it's just cumulative. And here end up with year to date, so with the latest value of today. Now what you see here is that the graphs become greener and greener and greener, which was to be expected, because at the end of the day we know that all the stocks, most of the stocks have grown over 10 years. But the advantage that it's giving me here is that it's also taking into account companies that started or that were listed after a certain date. So if they did not exist 10 years ago, well, they came on the stock market later on, I will also bring them into the equation. So I'm able now to look at all of the companies regardless of when they came on the stock market. But still, yet, we also here have to filter out all the companies, yeah, that were listed after a certain date. So I will do the exact same exercise here. Let's go to my yearly stats here, and I can remove those. And as you will see, and if I go back to my yearly returns, it will probably remove a lot of dates here. Now, here we have the graph I wanted to have. So here I have the 500 S&P 500 stocks, yeah, and I'm looking now to a cumulative return. So I'm looking at the cumulative return of all these stocks here over the last 10 years, at least during the period of last 10 years. And as you can see, for instance, Align Technology, well, it came into the S&P 500. Where is it here? It came into the S&P 500 in 2017. So I dropped 2017 and I only started to count as of 2018. So I think this is a fair view on the S&P 500. So I want to make sure that I don't draw conclusions for stocks that were listed before. Okay, so I sorted the list by cumulative return of the last 10 years from high to low. And you see here that the highest and the biggest grower of all S&P 500 stocks has been Nvidia. Nvidia has grown from a staggering 5,276%. Now, Nvidia really did extremely well. And now, if you would look for all the 10 baggers here, and that's going to 900, and you can see that we also have a few ones that are very close to be a 10 bagger, but this list here is the actual list of 10 baggers. So let's maybe dive a little bit more into those companies. What we see here, so Nvidia, Netflix, Adobe, Amazon, good old Amazon, Lam Research, and look, Lam Research only was listed, I guess, in 2012 and did very well after that. Another thing it's really important to notice here that not these stocks, however, they are 10 baggers, but not every year has been as successful for those companies. Look at this, Netflix was down like 60% the first year, right? Look at this also, Lam Research was down 26%. Amazon was down 22% in 2014. So probably a lot of people would have just dropped their shares there. And look at the year after that, it went up 117%. So it's really, really a very bumpy ride most of the time to get to these results here. What we see here is that most of the companies, most of the really successful companies here are technology companies. Consumer discretionary, as I said, yeah, you could argue, is it technology or not? Netflix, Amazon, technology, financials, MasterCard, Visa, both are 10 baggers, quite impressive, yeah. Consumer discretionary, so here, Apple is also a 10 bagger, healthcare is also represented here by Intuitive Surgical and by Thermo Fisher, which is more like healthcare equipment. Microsoft is in here, and well, Sherwin-Williams. That's quite impressive. I mean, I'm really surprised to see a consumer staples company here being a 10 bagger in the S&P 500. Now, if you would even go lower and almost being 10 baggers, you see also other consumer staples like Home Depot. Home Depot, already a giant company, is also almost a 10 bagger in the S&P 500. We have here Lowe's companies. So as you can see, there are quite a lot of 10 baggers or companies really well on their way to become a 10 bagger. Okay, so what's our conclusion now? So the question was, if you invest money in an established company of the S&P 500, can you still make great returns? Well, we found out that 19, and I counted them, 19 S&P 500 stocks increased more than tenfold during the last decade. So the answer to the question is yes, you can still make great returns investing in established companies. And as also Peter Lynch would have stated it, is a company does great, the stock price will also do great. So find good companies, strong companies that will make a lot of profit in the future, and those companies will also return their profit to the shareholders. That's the conclusion here. There is a very important side note though, and that we also have seen in this video here, is that well, the last decade has been extremely successful for the stock exchange. So in general, the stock market has been in a bull market for 10 years. Maybe 2011 was a little bit of a rough start, but did extremely well in the last 10 years. So it could be that the next 10 years might be a total different story. I don't have a crystal ball. I don't know. So it could be there will be no 10 baggers in the stock exchange in the next 10 years. But the question was really, is it possible? And the answer is yes. And if it's yes today, well, we can really hope that it also will be the case in the future. So I hope you found this video quite valuable. So if you had any comments, please leave me some comments. Also, if you would like to have other questions answered or getting me to dive a little bit deeper in some of your questions that you might have, let me know. I hope you enjoyed this video. Please give me a like if you liked it. And well, I hope to see you very soon. Bye. Cheers.